Even today, one of the world's most richest and the most influential investor continues to be Warren Buffett. Finding the stocks of really good companies and investing in it for the long term is how Buffett made all of his wealth. So one of the methods Buffett invested in all of his companies was in a way called as value investing. Even in the book written by his guru, Benjamin Graham, he also talked widely about value investing as a topic. And in that book, there is a detailed way of analyzing a company in which you can understand if it's an undervalued company or a value stock or if you should avoid it. But based on this calculation, many investors and even Benjamin Graham himself thought it was too tough to implement, and that is how he came up with 7 simple rules on how to get started with value investing. So let us look at what value investing is and how you can use these 7 simple tools on a screener to identify all the undervalued or the value stocks which you can buy today in India. This is Ajay Ajith. Welcome to Market Feed. Value investing is a simple strategy which involves picking those stocks, those companies which are currently trading at a lower value than their intrinsic value. But easier said than done. How do you calculate or how do you find out that undervalued company? So you can easily look at a few factors. Either investors currently or the market currently is underestimating the stock, or due to a recent news or a recent event, the stock has fallen by a lot, but the fundamentals have not changed. Or it can be through your deep understanding of financial analysis that you come to the conclusion that this particular stock which you have chosen is an undervalued company. And the strategy was made very popular by Warren Buffett and his mentor Benjamin Graham and has been widely used throughout the world. So if you can find the right companies and if you're patient enough, in the long term, the company will come back to its true intrinsic value. That is a whole concept of value investing. And yes, the advantages are right there. Lower risk because you're buying at a cheaper price or valuation of the company. Again, a company which you think is really good, top notch quality at a cheap price. That is good. And two is the compounding effects that you'll get. Imagine you're buying a stock for 100 instead of 200, right? And whenever the stock price is going up, the percentage of returns on your capital will be much higher because your average buying price is also very low. And since you've gotten into it with the whole mindset of long-term investing, you'll be able to hold it for a really long, right? And that will help you reap the benefits of this stock moving up in the long term. But as I said earlier, finding a stock which is under its intrinsic value is easier said than done. And Benjamin Graham also knew this. So he came out with 7 simple rules that we'll go through right now, with which you can easily identify a stock which is trading under its potential value, and then you can decide whether you want to invest in it or not. So let's get into Graham's 7 stock criteria for value investing. So the first criteria, size of the company. So Graham believed that whenever you're looking into a very small company, there is a high chance that there will be wild fluctuations in the company's financial numbers. So whenever a small company is, say, posting a profit of 20 crore rupees for a year, the next year it can be 50 crore rupees or it can go back down to 2 crore rupees. So the wild fluctuations in the revenue and profit numbers is something that we should avoid. So we should only look at fairly large companies which are stable in their earnings. So the first rule here for the Indian market, we're slightly modifying it as well. So for the first rule, we can think of it as market cap greater than 20,000 crore rupees. These are the only stocks that we're going to be looking into. So to identify these stocks, let's go to the screener.in website. It's not a paid promotion, just showing it to you here because it has a really good screening tool. And once you come here, you can give the rules. I'll share the rules down in the description as well. So let's go ahead and fill it. So here we are entering market capitalization greater than 20,000. The value is automatically in rupees crore, so you do not have to write anything here, and you can run this query so that you can understand how many companies in India are greater than 20,000 crore market cap. So you can see here quickly that 301 results have been found. So let's go back to the second criteria and reduce this even further. So the second criteria Graham wanted to look into was a healthy current ratio. So current ratio is a measure of what is the short-term liquidity of the company. How easily can this company maybe liquidate their assets and raise enough money to pay off their their liabilities. That is what current ratio looks to understand. So the formula of current ratio is very simple. Current ratio is equal to current assets divided by current liabilities. And whenever the numerator is higher, current assets are higher, current ratio, the number will also be higher, and it is generally considered better. So the ideal current ratio of a company might vary between different industries and sectors. So one thumb rule that you can remember is a current ratio of anywhere between 1.5 to 3 is ideal for a company, not less than 1.5 and not higher than 3. So yes, going back to screener here, we can add this query here. So write current ratio greater than 1.5 and current ratio less than 3. So let's go ahead and run this query. So we have gotten 111 results here, but that is not enough. We have to shorten this even further based on our 5 more rules. So let's get ahead. So the third criteria is dividend payment history. So here Graham says that if the company is doing really financially well and it is sound and stable, it will be giving healthy dividends across the last many years. So we do not have a screener query for this, but you can manually do it from whatever list of stocks that we are selecting. You can manually do the screening there itself. So the fourth criteria is earnings per share growth. So earnings per share or EPS is nothing but how much a company earns divided by its total number of shares. So you will be understanding how much wealth or how much returns, earnings is being generated by the company for every single shareholder. So Graham keeps it very simple here. So what you have to understand is if the company's EPS, earnings per share, is growing over the last multiple years, it is a good indication that the company is growing, and that is one company that you should be looking into. So once again, let's keep it simple here. Let's go ahead and give the query that EPS greater than last year. That means this year the EPS has grown, and EPS growth for the last 3 years has cumulatively given more than 10%. So this is an at least number. When you're done with the query, you'll be getting a certain list of stocks. After that, you'll have to go ahead and verify all of these numbers yourself. And moving ahead into the fifth criteria, which is price to earnings ratio. You might be knowing of this. PE ratio is equal to share price divided by earnings per share of the company. So once you do this, you'll be getting a formula there. And Benjamin Graham states that this PE ratio should be lesser than 9. But in India, generally we will not be getting much stocks below the PE ratio of 9. So we'll have to do some modification here. We can take the industry PE ratio here so that we'll understand if the stock is trading at a lesser valuation than the rest of its competitors in the same industry. So for the PE ratio, let's go ahead and give that a price to earning of the company is lesser than industry PE ratio. And now we have shortlisted down to just 22 stocks right now. Let's go ahead and do the next criteria. So the sixth criteria Graham said was a price to book value ratio. The PB ratio or the price to book value ratio is basically found out by dividing the price per share of the company by the book value per share of the company. The understanding here is that the book value will give an indication on what is going on behind the company's scenes. It looks at the total assets and the total liabilities, and we can easily understand what is a good value for the company here. So Graham said that a price to book value of less than 1.2 is ideal, but unfortunately these rules were written a very long time ago, and in India you generally won't find such stocks a less than 1.2 PB ratio. And the last criteria is financial leverage. So Benjamin Graham did not like companies with huge debt on their books, and he tried to avoid companies with much higher debts than their current assets. A company with low debt is likely to show sustainable growth over the future. Even if the company goes into a tough position in the future, they will not be squeezed into a tough situation where they'll have to pay a lot of interest on the debts that they are currently having. And he suggested looking at companies only with a total debt divided by current asset ratio of less than 1.1. So let's go ahead and enter this also in the last screener here. And let's go ahead and run this query. So yes, you can see just 7 companies here still in India following all of these rules. You can even maybe perfect it even further for the EPS rules and the other rules maybe according to your liking. But in the general sense, in Benjamin Graham's terms, these are undervalued gems in the country. They have a good market capitalization. They have a good current ratio, which is their short-term liquidity is good. they have good earnings per share growth, they have a good PB ratio, and their financial leverage is much lower. So these are companies that you should be definitely studying and thinking about investing in the later stage. So the ones that caught my eye, especially were NMDC, HCL Tech, and National Aluminium. I've earlier studied these stocks as well, and surely I'll be adding these to my watch list to pick them up at the right time. This is not a financial advice, and this entire concept has been modified based on rules created by Benjamin Graham many years ago. So make sure you do your own studies and do your fundamental analysis before investing your hard-earned money into any of these stocks. So hope you learned something new about all of the different concepts here. This is Ajay Ajith signing off. See you all in another video. Bye bye.